Okay, let's continue the events. My name is Ville-Pekka Sorsa. I work at the University of Helsinki, study many kinds of political economy issues, and I'm here to moderate this panel discussion, which, as you can see, includes our two distinguished guest professors who have been giving us fantastic presentations in the first session. Now in the second session, we are very happy to have three more distinguished guests in our panel. First, I'd like to present you Lena Sommestad, who is a Social Democrat member of the Swedish Parliament, a former Minister for the Environment, a Professor of Economic History at the Uppsala University, and a member of the board of the Swedish Central Bank, if I'm correct. So there's lots of knowledge with Lena here, and as Mikko said, we're very happy to have the Swedish experience here, which is always quite relevant concerning the we are Finns. Secondly, we have Jukka Pekkarinen, who is the Director General of the Economics Department at the Finnish Ministry of Finance. And for Finns, he doesn't need much presentations. He has been in the forefront of Finnish economic policy debates for at least 3 decades now, so I think we all know him. And then last is Olli Koski, who is the Chief Economist at SAK, one of the organizers of the event, which is a confederation of 20 trade unions in industry, public sector, transport and private services, and what I could say a traditional powerhouse of trade union activism in Finland. We have first reserved time, 5 minutes for each of the three new panelists to give brief comments to the presentations by Professors Galbraith and Wray, and the professors have time to respond to these comments before we start the actual panel. And we would be very happy to hear your comments on these presentations. Lena Sommestad, would you like to start with the comments? You said you have prepared something there.
Okay, thank you very much. And first, of course, I would like to thank Mr. Galbraith and Mr. Wray for their excellent presentations. As a long-term critic of the euro and also some of our economic policies, I think it's very important that we get this type of discussion on a high level. It's very, very important. So to me, it was important to come here. I think the topic of the day, the full employment topic, is the most important that we face as social democrats in Europe today. We have to challenge the very idea that it's impossible to fight unemployment, because that's what we actually have been doing for many years. We have accepted mass employment as something that is natural to a modern economy, and I think we have to restore the idea of full employment in the proper sense of the word, which to me means what we had in Sweden up to 1990, like 2 to 3% unemployment, not more than that, not 7 or 8 or 10 that we have in Sweden today. And we have to do it, of course, for economic reasons in order to get a maximum of wealth, as have been described here today, but also, as in particular Mr. Galbraith pointed out, also for the matter of democracy, social justice. We cannot get a society that is just and fair without full employment. And following this idea of full employment, we can see that a lot of those things that we want to get, we cannot get with unemployment. For example, we see in Europe now, when we look at women, we have declining birth rates, we have families in poverty, so the whole economy of reproduction is actually failing due to the fact that we have so much inequality, poverty, and lack of employment. And we cannot manage the greater problems that we face. In these days, governments from all over the world meet in Doha to discuss the climate issue. This is one of the issues that we can't manage because we don't put people into employment to invest in what we need to do to get a society that is more safe to the climate. So lots of things we cannot manage today because of this. I will say a few words on Sweden. As a Swedish member of parliament, I represent a nation that does not belong to the Eurozone, but has nevertheless some features in common with the Eurozone. You could say that we have a greater room for action. We could be more innovative in Sweden right now. We have more to do, but we don't do that much, I would say, to fight unemployment, in spite of the fact that this is on top of our agenda. And I would say that as a social democrat and as an economic historian, I would like Sweden to be a nation now that took the lead, that took the opportunity to take the lead at this moment for a paradigm shift along the lines proposed here by Mr. Wray and Mr. Galbraith to develop new policies. And we could discuss designs. There are different ways of doing things, but the approach is what we need. And why is this not done? Why doesn't Sweden go ahead, changing the ideas, doing something differently from the Eurozone when we have the liberty and the freedom to do so? Well, I think when we look at Sweden now, just to say what we do, we challenge some of the paradigm. We work a lot on job creation, on what we could call classic active labor market policies. We fight the conservative government on these issues. We want more of education, more of learning to swim, as Mr. Wray said, this type of labor market policies. We are strong on that. We are very different from conservatives. But we're not different on economic policy. We're not different on the broader principles on how to pursue economic policy. We do not challenge the conservative government on principles of low inflation targeting, not on the priority of balancing the budget, even having a surplus on the budget every year, for example. We've also given support to the Euro Pact, although we strongly emphasize that we don't have to follow those rules since we are not in the Euro. We are supporting the very idea of the Euro Pact, supporting it in order to being able to sit by the table. That we think is important. And I think it's telling that we did have some expansionary economic policies following directly after the 2008 crisis, as many countries in Europe had. But we very rapidly returned to the idea of balancing the budget, being very restrictive. Now we have even more of austerity policies almost than the conservative government. We say that we have a budget that is more for stimulus to the economy, but it's actually a bit smaller in size than the conservative budget. So why do we do this? What's so difficult by challenging the conservative government on this full employment issue? You could think that it would be differently for many reasons. First, that we have a very long tradition of full employment policy in Sweden. As we heard here, we have been a role model for many as regards active labor market policies, but also on demand management policies. Full employment has been a high priority for Sweden for many, many years, up to the 1990s. As I said, Sweden is not in the Eurozone. We decide ourselves what golden rules we want for a level of inflation, for example, budget balance. We have a floating exchange rate. We have a currency of our own, a sovereign currency. And the Swedish economy is very, very strong. We did have a huge crisis in the 1990s, like Finland, and at that time we had a public debt up to 75% of GDP. It has now gone down to 35% of GDP, far below the criteria of the EMU. Nevertheless, people continue to say that, well, we can't have a greater debt, we have to push it further down. So there's still the idea that we are perhaps dangerous to have expansionary policies. So in spite of a debt of only 35% to GDP, we still think we need a surplus on the budget every year. To end up by trying to explain this, I would say that we have an extremely strong idea of fiscal responsibility in Sweden right now. It's actually the most important political issue is to show that you are financially responsible. So this is what political debates are about. So there is a huge concern from the part of social democrats to say that you shouldn't keep to the golden rules of fiscal responsibility. The idea is that if you do that, you'll fail in elections. And I think that the explanation for this idea being so strong, apart from the idea being very strong everywhere, is the experience of the 1990s crisis. I think that the crisis in the 1990s was a tremendous experience for a generation of policymakers. This kind of shaped a generation of policymakers to say that never again will we go to the financial markets being poor and being in the situation like this. So this is kind of keeping to this is very, very important. At the same time, we have Finance Minister Anders Borg, who is very popular, very talkative and very good at talking, and he's very much in favor of austerity policies. And in the 1990s, the truth is that we were forced to employ austerity policies, but what saved the Swedish economy was the devaluation of the currency, the floating currency. And the same holds true for the 2008 recession. It was the devaluation following the recession that helped us to export and to come up from the deep of the crisis. But in the popular ideas, it is that we were so good at austerity policies, that we were so good at saving, that we were so responsible. And as Mr. Galbraith talked about, we have the rhetoric of, look at those people out there who are not as responsible as we are. If we are not responsible, we will soon come to the situation of Greece. So there is, people are scared of coming down to the same situation, so we keep to this. And of course, looking out to Europe and see nations being on the edge of starvation is a very strong signal of we have to save, we have to be responsible. You never know if 35% of debt is low enough. Perhaps we should be even lower to be on the safe side. Finally, there is also, I think, legitimate concerns for Sweden, and that is that although we have a sovereign currency and we have a floating exchange rate, Sweden is very exposed to financial markets due to the fact that we have large banks. Their balance sheets are as large as 4 times our GDP. That is a little bit of an Icelandic situation, not really the same, but approaching this situation. We save a lot abroad and we borrow a lot abroad. This means that even if we have a currency of our own, the day a bank fails, they will not need Swedish currency, they will need dollars. And for that sake, there is a legitimate concern for financial stability. We have housing markets booming, and booming by borrowing money from abroad. So there is a concern that is, I think, legitimate, and that raises the issue of, should we really have the open financial markets that make us so sensitive, and that makes the central bank choose to have a higher interest rate than they would have had otherwise. And this is a huge discussion in Sweden now, that the central bank actually has put the interest rate too high for many, many years, which has caused larger unemployment than was necessary. And if this is a result of a very, very open economy to financial markets, that raises the issue of how we want to design this in the longer run. I will just end up by saying that, to me, this is also an issue of values. It is an issue of how important is equality for us as social democrats, how important is full employment. I've been very, very surprised many times when I've come to colleagues in my party and I've said, look here, I have an article that says that we could get down unemployment like 40,000 jobs if we raised the inflation target or if we did something else. And people are not interested. They just say, we couldn't do that. I don't want to hear that. I don't want a seminar on that. And to me, if you're a social democrat, someone says to you, I have an idea how we could reduce inequality, how we could get people in jobs. I think you should at least answer, is this really so? Well, I should listen to you to see if there's something in it. I'm not sure, but I'll listen to you. So I hope we will listen now to Mr. Wray and Mr. Galbraith and others who say that there's something in it. We could actually get unemployment down. Thanks.
Thank you very much, Lena. Jukka, Pekkarinen, do you have comments to the two presentations? I would imagine so.
Thank you, Chair. Yes, I think although it's a risk, I try to comment the presentation at fresh, but I must say that Professor Wray in his talk was, dealt with some fundamental issues in economic theory, in macroeconomics, particularly issues which I think we can come later on in the debate if necessary. So in my comments I will deal more with a very interesting presentation by Professor Galbraith. And I will do this because I was struck by some of his statements which were strongly against the conventional wisdom, in my mind at least. Particularly I was struck by was the comment, actually the thesis made by Professor Galbraith, that in the US the welfare state institutions are much more institutionalized than in Europe. And that's something which was totally new to me, because I think we in Europe, particularly here in the north, we are proud with the fact, I think, that we have a well-established welfare state with strong institutions and also strong political support consensus from the left very much to the right. And this is shown in the facts, I think, which are facts as differences between US and Northern Europe, that if you look at the poverty rate, social stability and such indicators, they certainly are at a much better level here in the north. And this is also reflected in the fact that we don't need that much discretionary management of economic and social policies during the times of crisis, because the relatively large size of the welfare state and the automatic stabilizers built in the system take care of act as a buffers and take care of much of the impact of the crisis. This was quite clearly shown, for instance, by the crisis of the 2009 in Finland, where the GDP fell by 8%. That was not at all reflected in the real disposable income of the households, very much without any discrete decisions by the government, because it was the progressive taxation, social security, safety net, and other welfare state institutions which act as a stabilizers vis-à-vis the impact of the crisis on the household sector. And it's a matter of fact that the size of automatic stabilizers also on the basis of statistical comparisons is much higher here in Europe, particularly in the north, than the in the US. So my interpretation or conception of the US system is so that due to the lack of strong welfare state institutions, US is very much more dependent on discrete policy actions and initiative by the executive in particular during time of the crisis. And so that and of course the positive side is that there is much more innovations in US policy making, but these very often are innovations which don't have that kind of institutional continuity as we have here in Europe. And now this brings me to the question of the crisis in the Eurozone, which I think is time for reconsidering some of the building blocks of the European welfare system. I think it's right to say, to put it sweeping, that the institutions, economic policy institutions of the Eurozone were very much based and built upon, of course, let me say, a German concept of a federal state, where as a starting point there was this conception, which I think was rightly so, that in Europe the welfare institutions are national institutions, and they provide a kind of the stability mechanism which diminishes the need for discretionary action during the times of crisis. And then at the federal level, which we don't, if we can use this term. At the federal level, we have a stability and growth backed, a kind of German types of rules-based economic policy making, so that within tight limits, the fiscal balance in the member countries of the Eurozone can adjust. And from the beginning, I think, from the start, the idea was that this fiscal mechanism will allow for automatic stabilizers, strong automatic stabilizers to work. Then, when the crisis deepened during the last few years, this growth and stability and growth pact was gradually made more tighter by a German type of approach, built of more discipline and more careful in investigation of the policy making in the member states. And now I think it's a kind of a general understanding of the crisis that in building up this European system of a kind of federal system, we forgot something. And we forgot something which was actually was the very reason of the crisis. And it was the fact, which we realized later on, that very rapidly Eurozone created a kind of integrated financial market. And then, as Professor Galbraith said, when the financial crisis which started as a result of the global imbalances in the US and came to Europe, which also had a kind of a massive increase in the amount of credit, this led to this, when the crisis became heated, this came to the banking crisis. And then we just realized that in the Eurozone we have no upper-level mechanisms to deal with the banking crisis. And that, I think, is the pattern of the inability of the Europeans to work and to combat the crisis. And I think it's also the fundamental crisis of the reason of the crisis. It's not the fiscal crisis at the bottom, at the end of the day, it's a banking crisis. And now I think the European decision makers have gradually realized that what we need in Europe in the future is not that much of a fiscal union, because we have sound fiscal institution at the national level, but it's a kind of a financial union, banking union, which is here in Finland in particular, it's a bad word, but I think that's rightly so, so that we need some kind of a joint common deposit insurance system, some kind of a joint banking supervision system, and also some kind of a joint banking rescue system for rescue operation, if so needed, rescue operation where also the private sector and the private creditors are involved with, so that there's a kind of bailed-in feature in the rescue operation as well. So I think there's this understanding now, but taking into account the very weak nature of the federal institutions of Europe, I think it takes a long way really to get into a kind of real banking union in Europe. So that I think it's too much to hope of the present day Europe that the banking union will provide some immediate help for the present crisis. So that I think, which is sorry to say, that politically Europe is so weak and laden even more tensions as a result of the crisis, so that it's the only alternative we are left with is this kind of a muddling through, where I think, again, in a German-led way, we will do the minimum necessary what is needed to keep the Eurozone together, and just waiting for the better days, and I think the history teaches us that at the end of the day, the financial crises, they come and go, so that there will be brighter days. Perhaps we will hope brighter days, which also will give us the opportunity to build up gradually a more solid system here in Europe, so that we can, I hope so, also learn from this crisis. Thank you.
Thank you, Jukka Pekkarinen. There was some direct questions to our presentees, but first I would like to have Olli Koski to give. You already also have some comments there, and after that it would be great if you could respond to the comments.
Thank you, Chair. It's a great pleasure to see so many people here listening to what is a very important topic, the return of full employment policy. And we have had the pleasure of listening to two very good, very refreshing presentations, something you very rarely hear in the Finnish economic debate, unfortunately. I sketched my reaction during the talks, so forgive me if I have some loose ends in the argumentation, but my comment is, I have three themes on my comment. First is money, second is the European situation, and third, jobs, the job guarantee that Mr. Wray put forward to us. But let's first start with money. What is money? Money is debt. And what is debt? Debt is paper. And too much debt from the viewpoint of debtors is, as Mr. Galbraith put it, paper shackles. And that's, I think, what you need to understand. You can, the history of economic history can be read through can be interpreted as a sort of battle between the idea of sound money and soft money. If you are a favor of sound money, then you like inflation targets. Maybe you like back in the old days you liked the idea of having the currency bound to a gold standard, the amount of gold or silver that is circulating in the economy, that sort of thing. You would like to have inflation under control and strict targets for that. But if you like soft money, then you would be more expansionary on your monetary policies. You would not care so much about inflation targets, but rather get things done, get people back into work, and use monetary policy for that. Increase the supply of money any ways needed. So, and economic history can be seen through this, seen as a battle between sound money and soft money. And we have seen that soft money has prevailed for very long periods of history. And I think the key to understanding this European debt crisis, the full financial crisis in the global economy is to understand that debt in a way is a claim on expected growth, on expected future incomes of the debtor. And everybody, the banks, the nature of money is endogenous, as Mr. Wray put it. Well, basically everybody can create money by creating debt. So money is not a well-defined concept in that way. And this debt creation, it's based on trust that the economy will grow in the future, the incomes of the debtors will grow in the future, and that's why you lend money. And when you're lending money, you're creating money. And now we are experiencing, as Mr. Galbraith said, a very classical boom and bust, a financial crisis. There was too high expectations on growth. Well, as Rogoff and Reinhardt put it, everybody thought that this time was different, but it was not different. So we had not moved to a new phase in economic growth where we could sustain such a high growth rate forever and so on. The internet economy didn't prove to be so revolutionary as some people thought in the beginning and so on. So this trust in the new electronic economy and so on has now diminished. A great amount of debt has proven to be worthless. there is not going to be that kind of growth in Greece and Spain and all other places where that could sustain this kind of debt level so that people could repay their debts. That's a fact. And now, moving on to Europe, I think the tragic error of the European policymakers, including the European Commission, the European Council, and specifically the Directorate for Economic and Monetary Affairs in the Commission, including the Commissioner himself, there's a tragic error of not looking at the problem as it is, and a great reluctance to admit that we are experiencing a debt crisis, a financial crisis. That the only way of solving this in this situation is a debt reduction, losing the paper shackles from the over-indebted nations and individuals and households and so on. If this would have been done in the first place, then we would have experienced private sector involvement in the debt reduction plans. But now, my understanding is that now that we have embarked on this right-wing course on solving the crisis, that we are so-called putting forward these solidaristic help packages for Greece and other countries, they are the opposite of solidaristic. They are exploiting the countries, stripping the countries out of future growth. And while we have done this, we have moved a great part of the debt to be held by public officials and not anymore private banks. So in a way we have rescued the banks, and the debt is still there, and it's on the public balance sheet. So this is the tragic error of handling the situation in Europe. I think Mr. Pekkarinen was right in that we need a banking union, and we need a mechanism to solve this current situation, not just the future crisis, but this current situation of separating the banks from the sovereigns and somehow dealing with the banking crisis we are seeing in Europe. As a matter of this, Mr. Galbraith talked about that the core functions of the state were being questioned during the crisis. Yes, and that's totally unacceptable. What is needed in the European framework is a lender of last resort, but not for sovereigns, not unconditional lender of last resort. That's where maybe I have a different view from Mr. Wray, but that's, I think that we need a lender of last resort. The European Central Bank should be a lender of last resort, and it's becoming that. Now, through this muddling through process, it's now some kind of lender of last resort. But in connection to this, what is needed, we need a credible commitment by the governments that have to go to the bank to get their things in order. And I think nobody disagrees that the Southern European countries have a competitiveness problem, a real structural problem with their economies, low employment rates, uncompetitive business, and so on. So, and as well wage mechanisms that were not maybe suitable for this kind of economic architecture. So some kind of stabilization programs are needed in order to address this competitiveness issue. Mr. Galbraith talked about automatic stabilizers. The US has automatic stabilizers at the federal level. Medicare and Medicaid are federal programs, and we don't have this in Europe. All our automatic stabilizers are on the national level. And, well, the US system, one interesting feature of that actually is that although the Republicans are critical of Medicare and Medicaid, what these programs in effect are, they are a great system of transferring income from the blue states to the red states. So it's the Republicans who are benefiting, the Republican states who are the most benefiting. You can correct me if I'm wrong, but I think this is what the case, and maybe all this fiscal cliff talk in the US is a kind of blackmailing the Democrats of more to becoming more Republican. So, but We don't have these federal level automatic stabilizers in Europe, and well, that's something for the rest of the panel, I think, to discuss. Should we have more automatic stabilizers at the European level? At the moment, the Commission has put forward these kind of suggestions, now issues for discussion. I am myself very critical of these ideas. I think the current European framework is totally unsuitable for these stabilizers at the Union level. We are too disintegrated for that, politically and culturally. That's the most important thing. But concluding the theme of Europe, I think we are now muddling through to solving the crisis. But it will take years, and it's a tragic error that we did fail to see the problem as what it really was in the beginning, and made some errors there. And finally, about the jobs guarantee. My organization, well, we in SAK have put forward something that's called job guarantee, but that's maybe in a more limited form than what Professor Wray was putting forward here for this audience. We are for a great deal of Finnish unemployed are long-term unemployed. This was a phenomenon that grew during the big crisis of the early 90s here, the big financial crisis, and ever since that we have had a great amount of long-term unemployed and a large number of structurally unemployed people. And for the long-term unemployed, I think we would need some kind of system of employer of last resort. My personal feeling is that it would be the municipalities that would have to have responsibility for organizing this, to have municipality local level jobs for the unemployed, long-term unemployed, and so on. But I would not rule out state here. And of course the resources would somehow have to come from the state, and the state would have to guarantee the resources for the municipalities for these activities. So concluding, resources for the jobs guarantee, maybe in the future from the central bank. Maybe there are some problems as well financing these programs from the central bank. But a question maybe for Professor Wray, that is there such a big difference that if we are financing them through taxation, through the state budget, that means that the rest of us, we who are working and earning a salary, we are taxed from our incomes, and as a solidaristic gesture, as a solidaristic policy, we are using these tax euros and tax dollars to finance for the job guarantee programs. So is this in the end so much different from financing from the central bank, which ultimately I think would lead of financing these programs from the creditors' pockets? Thanks.
Okay, thank you. Did you have something very specific at the last point?
Yeah, actually that was a comment, because if I remember correctly, we in Finland actually had a job guarantee very well established until 1960s, where really the municipalities had that it was legislated that they have to offer job for the unemployed. And actually, Pertti Sorsa, you were at the Ministry of Labour at the time, where there was a short-time job guarantee at the end of the 80s. It was legislated, but it was repealed very rapidly when the crisis came in. So actually, these are ancient thoughts, these kind of job guarantees, which were actually pre-capitalist ideas, which were preserved here in Europe for a long time, but they were considered as too paternalistic and not to fit the basic functions of a market economy, which I think is an interesting topic really to discuss.
So at least we have experience both institutionally and politically about full employment job guarantees. Can I have Professor Galbraith, would you like to start responding?
I will confine my remarks to a response to Mr. Pekkarinen, remarks I appreciated very much. He expressed a difference of view with me on the comparison between the stabilizing institutions and in Europe and the United States. But you will notice, if you listened carefully, that he slipped in a qualifier, an adjective that I did not use in his description of Europe. And that qualifying adjective was northern. Right? And it's all very well. We have no disagreement if you narrow the basis of the comparison. I have nothing but admiration for the stabilizing institutions of Northern Europe and the effectiveness with which they worked in the crisis. You say there's an 8% drop in GDP and virtually no impact on household income. But that's a country of 5.5 million people, smaller than the state of Wisconsin. Right? 1/4 the size of metropolitan New York City. Right? 1/2 the size of Greece, which has 11 million people. And the comment that you make about what you were able to do in Finland cannot be applied to Greece, where there has been a steady 5% or so decline in incomes for 6 solid years. It's now 30% or so below what it was. Or in Spain, where the unemployment rate is 25% on average and 50% in many of the poorer regions. And the problem that I'm addressing is a problem not of the individual successful models in certain parts of Europe, but of the structure of Europe as a whole. And I think we have no disagreement about this. But I would say on the US side, not to underestimate the effectiveness with which the automatic stabilizers in fact did work. The US did rely a little bit more on discretionary policies, this so-called stimulus bill, which was a good thing. But it was only a fraction of the overall stabilization, which had a lot more to do with institutions that were already in place. Unemployment insurance, Social Security, Medicare, Medicaid, disability, a whole range of things that people were able to rely on. Very patchwork, piecemeal, uneven, and supplemented by the fact that households simply stopped paying their debts, which also helps their cash flow. All of these things, but the stabilization was there. I think I'd have to check the numbers, but I would say we suffered 10% drop in GDP and only a 2% drop in household income. So it's very effective stabilization at the level of a country which has over 300 million people in it. Right? Very important. Second point, which has to do with the movement of your argument toward the European focus, which I agree with you, is now at the policy level, the central preoccupation of dealing with the financial crisis by dealing with the financial system, moving toward a banking union, insurance, supervision, rescue mechanisms. First of all, I think that one should not underestimate the extent to which Europe has already moved in that direction. The European Central Bank's charter is, as written, is a dead letter. Mr. Draghi buys the bonds that he sees fit to buy. And the purpose of that is to make sure that the assets do not have to be written off, and therefore the banks can maintain a pretense of solvency that they, in fact, don't enjoy. And that's exactly the same thing that the Federal Reserve does with quantitative easing, essentially. So the two central banks are, I think, operating with great autonomy and enormous effective power in keeping zombie banking institutions alive. Zombie is a term which refers to the walking dead. Large, expensive institutions that impose a major burden on the economy and do not serve any noticeable public purpose in the current environment, like they're not making loans to provide jobs. Okay? Will this work as a solution to the European crisis? My view is it absolutely will not. Nor has quantitative easing helped restore the US economy. Quite in parallel, we have, as I say, the stabilizing mechanisms that have stabilized our economy and the monetary mechanisms that have stabilized useless banks. But neither of them will work to bring the economy back toward full recovery. And in Europe, you have the stabilizing financial mechanism, but not the stabilizing income mechanisms, transfer mechanisms. And unfortunately, until one has those, you're going to have divergence you're going to have a continuing relative decline of the weaker parties and the descent toward a disastrous outcome. That's my fear. So that's my third point. I think Mr. Pekkarinen has said it correctly, that the approach in Europe right now is to muddle through and wait for better days. But I would warn you that things can always get worse. They can always get worse. And that's the direction it seems to me that they're heading.
Thank you. Sir Wray, can you?
Okay, well, first I just wanted to make a quick comment on Sweden, which I personally don't know anything about, but there's a very good book by Helen Ginsberg who talks about the Swedish model, and then she develops a form of employer of last resort based on the Swedish model. And she said that the argument in Sweden always was that we're a small nation. We cannot afford unemployment. Therefore, we have to maintain full employment. And it seems to me that's the right strategy. Small nations can't afford the luxury of unemployed people. They need to get everybody working, and that then leads to full employment policy. And you mentioned the external debt and the debt ratios, and I noticed, I briefly looked at some data for Finland, and it's pretty amazing how quickly your external debt is growing, in spite of only a very small current account deficit and a very small budget deficit. The external debt increased from something like 370 billion in 2010 to 577 billion in 2011. So you've got, according to the CIA, you have a massive run-up, which has got to be the banks owing other banks. And this, as Ireland shows, is extremely dangerous. It's not the budget deficit you should be worrying about. It's this run-up of bank debt, and probably a lot of it is in foreign currencies. So that is very scary. Let me just get back to Jamie mentioned, I think, the formation of the euro took place at the same time that modern macroeconomic theory was being developed and became dominant. And just let me remind you what the assumptions are behind this model on which the European Union was designed. First, that everybody has rational expectations. Markets are efficient, which basically means that markets know what they're doing. You have very strong equilibrating forces in the market. So if you move away from equilibrium, the market forces will move you right back. It's a very negative view of institutions. Institutions are mostly bad things. They get in the way of the market forces that are equilibrating. And what are the worst kinds of institutions? Well, government, which imposes constraints on market performance, therefore interferes with the market. Labor unions interfere with the operation of the labor market. So what we need to do is reduce the institutional constraints that are preventing the market forces from operating. There's the belief that monetary policy really works, and it should be focused on one thing and one thing only, which is inflation fighting. And therefore you centralize monetary policy making in the hands of the ECB, basically following the German model, which is that inflation is always and everywhere a bad thing that has to be fought. And finally, that you don't need, fiscal policy basically is impotent, that for every dollar the government spends, the private sector just spends a dollar less. So we have almost complete, or even more than complete, crowding out of public spending. And therefore there's no need for a centralized fiscal authority. And in addition, there are other political problems of doing that. So we'll just allow decentralized fiscal policy, and we're going to constrain governments with the master criteria, the euphemistically named the Stability and Growth Pact, which of course actually was the Instability and No Growth Pact. And it was, Okay, now step back. How's that working for you? Not very well, and in fact, it never worked well. It never worked well, okay? For a very long time, well, Germany was one of the worst abusers of the pact, right? It persistently exceeded the criteria. And then because, partly coincidence, the fall of the Berlin Wall, but partly by design of the euro, it was designed to favor the industrial power, which turned out to be Germany. As long as they could keep wages in check, they were going to outcompete everybody else. And therefore, their current account turned around. And that current account, because of the sectoral balance that I mentioned before, allows their private sector to run surpluses. Therefore, their private sector doesn't get heavily into debt, even as their budget deficit goes down. Okay, now the problem for everybody else was that if they kept their budget deficit down and they ran a trade surplus against Germany, their private sector, by definition, had to run budget deficits, which meant they got heavily indebted. And so I do agree with the comment that the problem here was a financial crisis, but where did the financial crisis come from? Okay, in the case of Spain, it's a household debt problem. Why did they have a household debt problem? Because their government ran budget surpluses as a good German country, right? But without the advantage of a current account surplus against the rest of Europe. And so we finally end up in this situation of heavy private indebtedness and current account deficits and financial crises. And when the crises came, I absolutely agree, there was no plan for any centralized response because finance was an individual member responsibility. You're supposed to regulate and supervise them, although you don't really need to do that because we know that financial markets are efficient and banks will never do anything stupid, okay? And then we have, not only are they, lending to households, running up household debt, but they're also engaged in all of this external finance stuff. And it's not lending in the normal sense of the term. It is issuing liabilities to other financial institutions that use those as collateral to borrow against other financial institutions. It is debt on debt on debt on debt, and that is why you can get Ireland with a debt ratio of 10 times GDP. You can get the United States with a debt ratio of 5 times GDP. You can get the financial sector's indebtedness to itself is 125% of GDP in the United States. This is banks owing banks. Why on earth are they doing this? As Jamie said, serves no useful social purpose whatsoever, and it's a brand new thing. It did not exist 20 years ago. Okay? Banks issued liabilities to households and firms. We call them deposits. Okay, big banks don't operate that way anymore. They issue liabilities to other financial institutions that issue liabilities to finance their purchase in those liabilities. Okay? So it's all debt on debt. And how did that work out? Not well for anybody. Okay. I tend to agree with everything Jamie said about the United States' ability to stabilize itself in spite of itself. No matter how bad our politicians are, and they are unbelievably bad, we still have institutions and a counter-cyclical budget that will allow us to bump along the ground for a while. Jamie talked about Greece, and we see movements in Italy and in Spain and in Portugal, separatist movements and really scary things. Now, the U.S. has the capacity for these things too, and so I'm less optimistic than Jamie. I think that a few more years of a really rotten economy and high unemployment and no job prospects for college graduates is going to lead to a lot of social instability. And I think Jamie and I disagree on this, but I'm also scared about the United States. On the other hand, that might finally get politicians to change the policies. and to actually try to do something about the unemployment problem. There were a whole bunch of other things I was going to say. But
Yeah, Lena had a comment, then Jukka, Pekkarinen, and then we go to some more thematic things.
Short comment on the automatic stabilizers. I agree with Pekka on the difference between Europe and the US, and we know that US fear deflation and Europe fears inflation. However, what is problematic in recent years is that we have actually, through the flexibilization of labor markets and reduced compensation when you're unemployed, etc. In Sweden, this is very clear, in other countries as well. We have actually weakened our automatic stabilizer while not changing the overall economic policy. So I think now we have the worst thing of both in Europe, both the European kind of, US kind of low security, social security, and the problem of economic policy that does not act aggressively in a times of crisis. I would also like to just comment on what Pekka said on muddling through. I think it's important to think about, will it really be possible to muddle through? I agree with Mr. Wray and Mr. Galbraith on the risks of social disintegration, and I think it's very, very dangerous. And also on poverty, on lack of growth, and all this xenophobia. We see so many scaring things going on, so we have to ask ourselves, how important is it to really keep to the euro with all these troublesome consequences, in spite of the problems of breaking this up now? And I would like to remind about the situation of Sweden. If Sweden had been Greece in 1992, we were running out of money in our foreign exchange reserves, so we simply had finally to leave the peg to the European cooperation on the exchange rate and let our currency float. If we had been Greece, we have got more and more money to help us to keep this impossible situation going. We had to stop, and we devaluated, and we came back, as Iceland is doing. So I think it could be better for countries to get finally a stop and a restart, and I think we have to think about that.
Thank you, Chairman. Actually, I had two sets of comments, very short, and the first one is very short. That's on Professor Brenn's view on the financial debt of the Finnish economy. You very well told the story of banking debt on debt on debt, which also makes that it's very, very difficult to read financial statistics. And we have in Europe, in Scandinavia, in the north, a very integrated banking system. And so we have joint Nordic banks. And now the biggest of these Nordic banks, the Nordea, has shifted its derivatives on the books of the Finnish subsidiary, and that's really the basic explanation for the change in the statistics, which is not that serious as such, because I think as a whole the Nordic banking system is relatively well capitalized and is certainly some of the soundest part in the European banking nowadays.
So it's bets on death. That's what derivatives are. Bets on death.
And my second comment was to Professor Galbraith. I think we very much actually agree. And I am ready to admit that we in Europe, we have very much to learn from the US experience and really on the strength of the US federal institutions. And basically that's for instance, in the case of the banking system, I somewhere saw a comparison with the state of Nevada in the US and Ireland here in Europe. They are of the relatively same size as far as the GDP and the population is concerned, and the size of the assets of the banking sector in Ireland was 9 times of the GDP. It was very high in Nevada also. I don't remember the figures, but that was a kind of a banking hub in the States. But there was no there was a real estate collapse both in Nevada and in Ireland, so that boom and bust experience was very much the same, but there was no banking crisis in Nevada because there was this kind of federal banking insurance system and rescue mechanism, which was not in place in Europe. So I think both politically and economically, it's the most important thing to learn from the crisis is Europe is really to create a kind of a banking union in Europe too. You mentioned also the fiscal transfer system, where also at the federal level, Europe is more meager than US because we are relying on national welfare states. But I think, particularly here in Finland, I think we have to admit that the political difficulties on this way are very, very big, very high indeed, because there is not that kind of a political solidarity in Europe at the moment. And I'm sorry to say, as a result of crisis, the likelihood of that kind of a fiscal transfer system is even more lower than it was before the crisis. That's a sad thing, but that's the reality in the present day Europe.
Okay. I've had ideas that we should have 3 topics we should discuss in the panel now, but as you can see, the time is running, so I think we're limited to 2. And the first one, as we saw, institutions matter greatly. The Eurozone institutions are very important in limiting employment policy and so forth. But actually, there's one question from the audience, which I think is interesting one here. And especially what Lena Sommestad said about the Swedish case is that even though you would have the institutions to pretty effectively conduct employment policy, still you are not willing to do it. And this is what Professor Wray called the self-imposed restraints or constraints for all this. But when we take the question to the European level, I mean, like, to the core of it, I think this question is quite good in terms when we start to think about employment policy. It says, Professor Wray presented us with 2 paths to a job guarantee. One through a sovereign currency, which has now been made impossible, thanks to this for Finnish politicians, to Finnish trade unions and social democrat leaders who drove us into the Eurozone. Or, secondly, through a federal European Union with the political will to distance itself from neoliberalism. Given that a modest citizen's proposal for bank reform was recently deemed by the Commission to be against the Union's core values and thus refused, this also seems impossible. So, I mean, if we want to fight unemployment and create new jobs, I mean, what is the practical way forward from all this? I mean, is it a matter of national policy? Should we try to change the Eurozone institutions? Should we perhaps try to create some sort of European level mechanism like the job guarantee scheme, or just to break down the whole Eurozone altogether? I mean, I would be really interested, I mean, I believe that the audience would be really interested as well to hear your opinions on this. Can we have, just go from here to there, so for, let's say, 2 minutes each, or 3, if you have a lot to say about this.
Well, first of all, I think the first condition for improving the employment situation in Europe and in Finland is solving the European debt crisis. And I think I have put forward our ideas on how we should move forward to that direction, addressing the real problem, writing down debt that will never be repaid, and so on, then rescuing the banks that need to be rescued. And this, Mr. Galbraith said, we are keeping the zombie banks alive at the moment. That we might be doing. What we need is some kind of European banking restructuring mechanism or something like that to resurrect these zombies into living human beings or living banks. Maybe let some of them go and then restructuring them so that we would have a sound financial system. This would require, I think, some aspect of European solidarism for the common good and political leadership to address the banking problem. And it's a difficult question, something where moral hazard and all these kinds of things have to be addressed. But some kind of European mechanism for restructuring the banks, is needed. That's the way to solve the debt crisis and achieving sound economic growth in the future. For employment policy, the main responsibility lies with the national governments. European transfer mechanisms on a massive scale, as in the States, as Medicaid or Medicare, are maybe unfortunately totally politically unrealistic for maybe my generation for a very long time. I think we are not seeing any that sort of movement. But maybe I'm wrong. Hopefully I'm wrong. But I would not be arguing that somebody has to come up with that kind of propositions for massive transfer mechanisms inside the European Union. Maybe Mr. Galbraith will conclude from this that there is no hope for the euro. And, well, then it is. It's game over then. Yeah, that's it.
Okay, Randy.
Okay, well, I don't think it's hard to come up with economic solutions to either the periphery debt problems, the bank problems, or the job guarantee program. So, I mean, the framing of the question is, you know, this is a political problem, and that is probably something that's very difficult to resolve and probably something economists are not too good at resolving. What I would avoid doing is using the word transfer. This is not a transfer payment. What we want to do is create new purchasing power, not take it away from anyone. Okay? So we're not going to be taking money away out of the hands of Finnish and German workers to put it in to the hands of new workers in a job guarantee program in Greece. We're going to create new purchasing power and put it in the hands of new workers in Greece. Everyone benefits from that. Nobody is worse off from that. Okay? So we have to move away from the notion that government spending only moves financial capacity or funding, whatever, money, whatever you want to call it, away from someone into someone else, because that is not what a central government does. That is what a local government does. Local government taxes from the taxpayer and then spends on a project, on a welfare program, whatever. They do transfer. Sovereign governments do not do that. That's the difference. Okay? Finland does to some extent rely on tax revenue because eventually the bond market vigilantes will go after you if you do too much of this creation of new purchasing power. Okay? But they cannot go after the fiscal sovereign, which you don't really have a fiscal sovereign right now in Europe. This is what you need to create.
We need one.
I will respond on another level, on the level of values. I think there are in fact conflicting values in the European Union. There's the very strong value of integrated markets, of competitiveness, that is kind of the key in our treaty. But following the idea of the internal market is the idea of sustainable development, which is actually the paragraph just following the one of the internal market. And these ones are conflicting. They are, in fact, it's not really consistency in the ideas that we have. Because if you really mean what you say about sustainable development in European discourse, when we talk about the strategy of Europe 2020, for example, when we talk a lot about sustainability and environment and social cohesion, etc., that would mean another type of economic policy. Because if you have the type of economic policy that we have now, and the monetary policies that we have now, these policies actually disintegrate. They don't go together with sustainable development. So I think we should need on that very much more of a discursive level, actually show that this is not, they don't go together, and we have to ask what's most important. What's most important for Europe? That families in Greece keep together, that kids get education, that we keep social conflict low. That's what we mean by social cohesion. Is it important that we can invest to fight climate change? If this is really important, we have to adapt economic policies in order to being able to do that. Now, when we come to the situation when these values come into conflict, what always happens is that sustainable development comes second. So we give priority to these ideas of neoliberal policies. And I think this is not what we actually want. And what I think is interesting is that if you go into the European Union and all the staff working there and all the policymakers, there is so much knowledge on how you can work on social cohesion, to fight poverty, to work on employment policies. We have the European Employment Strategy, for example, worked for years. We have the Lisbon Strategy with lots of good policy making for how to keep the society together to be sustainable. So we could put that all on top if we just could give priority to this type of values. Thank you.
Thank you.
Yes, thank you. I try to respond to the questions by the chairman from two different but related angles. I think first there is the short-run stabilization view, a problem where I think we have to build more robust stability institutions in Europe, including the banking union, perhaps some kind of a transfer systems. So there's a lot to think and a lot to work to do there after the crisis. And if I may just dare to comment with a few words on the idea of the job guarantee Professor Friend put forward. I think a credible job guarantee first assumes that there has to be guarantee that there is no inflationary way out of the economic difficulties, and that's very, very difficult to combine in a persistent way with unconditional job guarantee. But then there is also another precondition, and that's the credibility of the economic policies, and particularly the country has to keep on the current account balance, at least in the long run. And there, I think, is also a kind of a difference between the US and European system, because US, in a way, is a free rider in the global financial system, because thanks to the role of the dollar as an established international reserve currency, actually the US has much more freedom of maneuver, even in short-term stabilizationary measures, because there is no market backlash from the huge current account deficit in the US on the financial markets, which is not the case in the crisis countries in Europe now, because it's a confidence crisis at the same time. And that's something which has to be taken into account in comparing economic policies, stabilization policies today in Europe and in the United States. But then, in the long run, I think the whole comes to the questions of growth, competitiveness and jobs, where I think we have to admit that the starting point of Europe is not very optimistic. We are a rapidly aging society. We will face a shortage of labor in future decades to take care of the elderly people here. And we will see a flow of immigration, where our institutions are not that well adapted to take amount of immigration as in the States. The immigrants in the European labor markets, they are generally in a weaker position than they are in the US. So that I think it's the smooth functioning of the labor market in the future, which is very important, so that to create more labor supply. I think that's the key for our future problems, really, to preserve our welfare society and also to come in an egalitarian way out of this demographic change, which is unavoidable. Thank you.
James.
Well, I have 7 quick proposals to make. Three of them are the components of what is called the modest proposal, authored by the Greek economist Yannis Varoufakis and the British economist Stuart Holland. And these are direct responses to the European crisis, compliant with current European laws and treaties. The first piece of it is to take the Maastricht compliant proportion of national debts, which is to say the first 60% of GDP, and place it all in a common pool so as to reduce the interest burden on everybody. Then you'd have to see what, for those countries that are very far over the Maastricht limit, what you do, whether you have to restructure the remaining debt, but you might not have to. That might be sufficient to deal with the immediate debt crisis. Second piece of it is to use the European Investment Bank, which is several times larger than the World Bank at least, to fund a reconstruction project and investment program to begin the rebuilding of particularly of the European periphery. The third piece is to give the European Financial Stabilization Fund something to do, and that is to act as the supervisor of the banks and to begin this process of unifying bank supervision. I will transform that into my fourth proposal, which I'll call the less modest proposal, which is to say that the banking system, which in Europe, as in the United States, is hypertrophied, much too large, not useful at all, needs to be restructured and downsized. And then you have banks which are serving public purpose. You're in a period in which what you need are financial institutions that do what the society needs them to do. We've seen this before. This was the case in the Reconstruction after the Second World War. It's the case now. It's a question of getting institutions that are led by people who are dedicated to that purpose and who are supervised by people who are dedicated to that purpose. Okay, now I'll come to the immodest proposals. The first one is a European pension union. And by that, I mean this is exactly in line with what Randy said, creating purchasing power where it does not exist, by taking people who are already out of the labor force, who are in the poorer regions of Europe, and bringing up their purchasing power to some common European standard, so that they don't retire on the productivity of an impoverished country, but rather on the productivity of Europe as a whole. This would give them the capacity to deal with their aging problem by bringing people into their homes to provide them with care, whatever else that they happen to need, so it would absorb unemployed resources where they presently exist. Similarly, I would suggest something that might be a European topping up scheme for wages. That is to say, something that operates on a principle similar to the earned income tax credit in the United States. If your wages are low, you've got a supplement coming from the European center, and that then helps to stabilize the incomes of the lower wage countries. This would also help to restrain the forces that are currently pushing people to move and placing the kinds of strains that Jukka just mentioned on the welfare systems of the northern countries. Third idea is why is it that every country in Europe has its own defense budget? And why is it that when Greece, which has one of the highest military burdens in Europe, with perhaps 10% of its GDP, buys a submarine, it has to pay Germany for that? Right? It is not the case when we post a submarine to Alabama that the Alabamans have to pay the New Yorkers for it, or if it's built in Maine. Right? What's the point of this? Why not have a common defense fund and simply put all of that into some central budget and then allocate these resources rationally across Europe? It's not a very big piece of the European scene, but it is an important one. And then the question of jobs. I have a little bit of a difference with Randall. I think the job guarantee, I like the example of Argentina where you had the kind of energetic government that put this into effect. I think anybody in Greece would be very skeptical of the ability of the Greek government to manage such a scheme. After all, they have had a job guarantee scheme in Greece. It's called the public service. It was the way PASOK functioned in Greece, was to do that. So I think the way to approach this is to create stable job-creating institutions that are not quite state institutions, parastatal institutions. This is the way the nonprofit sector functions. And I think that looking at the way one provides higher education in particular and similar kinds of labor-absorbing public services is a very sensible way to create a lot of jobs, also to bring young people off the labor market. And if you can do that, you can at least begin to deal with some of the most urgent aspects of the unemployment problem. I'm not against the job guarantee problem, but I think one has to think about how to administer it in the specific institutional context that you face in each country, in each region. So those are my proposals. I think that the European project, the object should be to save it so long as it's salvageable. And the way of saving it is to move toward increasing convergence and to stop this relentless process of disintegration, which is plainly now underway.
Great, thank you. We still have time for one more topic, and actually this is something that, let's move away from the institutions and go more to the employment policy issues more generally. I mean, the name of the game in employment policy in Europe seems to be workfairism and competitiveness. I mean that we need to use the stick to get the people to work more, to add labor market flexibility, to cut wages, and all this stuff coming from the supply side economics. Well, my generation, people in our 30s, we have been told throughout our lives that there will be a great shortage of labor in the future, now that the baby boomers are retiring, that this is why we need workfairs. We need to get the young people to work. Well, now that the baby boomers have in part retired, we should have more jobs available than ever in Europe. Well, it seems not to be the case, and you don't even need to go to the crisis countries with youth employment rates of 60%. I mean, even in Finland, where companies are moving their production elsewhere, public sector is being cut. I mean, at least at the moment. A great number of people who have recently left the workforce, but still the unemployment rate hasn't gone down. Still there are many people unemployed. And we can't even see the kind of policies pushing for increase in effective demand, which is required for people to establish new businesses, to start working as entrepreneurs and so forth. So in a way, what I believe is some sort of general experience in my generation is that we are just told to work more, get less benefits, get less ability to cope with things like unemployment, but still we haven't been given any jobs. Just to test from the audience, people in their 20s, 30s, how many of you share this kind of feeling? As you can see, 2/3 of the crowd. So I would like to ask you, where are the jobs coming from? How do you see in Europe especially, where are the jobs coming from? And actually there's one question from audience which is pretty well related to this one. Could you comment on the export-driven growth model, which is the current paradigm in Finland? And so the kind of role of domestic markets, what could their role be? I mean, especially we have had a lot of talk that we should all export our way out of the crisis, but still, I mean, of course, you cannot do that. I mean, if we all export, then some people must import elsewhere, but seemingly that is not happening. But well, where will the jobs come from? And feel free, who wants to start? Okay, James, just like half a second before Randy.
Unfortunate incident when I got off the airplane yesterday, which required me to make a couple of stops at your very highly regarded and I think very effective healthcare system. It's all right, I'm fine. I noticed that the public hospital that there was that was not very crowded, but there was a wait of 3 hours to see a doctor. Right? If you had twice as many doctors, you could have reduced that to 1 hour. Right? Not a bad place to start. People need services, particularly those of us who are elderly, and I see a number of my compatriots in that blessed estate. We need people to take care of us. All right? That's what young people are there for. But they should be paid for this, and this is an activity which it's environmentally quite sound and sustainable. But you need institutions, public institutions, or as I just said, non-profit institutions that are viable, that create these employments and that supervise them. Right? Is there anything wrong with having a few of us employed and the rest of you subsidized to sit in audiences and listen to us talk? It's a very good way to run a society, actually. Do we need people cutting timber or making products? Well, we need a few of them. We need a few farmers too, but two in 100 is quite adequate for that purpose by and large, given the way agricultural technology has run. Manufacturing is not going to be very many more than that, and many of those are going to be in China anyway. So we should organize our societies to deal with the problems that we have, including the environmental issues and the climate issues, which have an engineering component and a human activity component, to create societies which are mutually beneficial, cooperative, and relatively low impact. Right? I think that's the common sense way to proceed. And the European issue is, of course, complicated by the fact that you have to do this on a transnational basis. But thinking about what to do in the small countries and the successful countries with some margin of maneuver in Northern Europe, that's where I would begin on the job front.
Okay. Randy, then Lena.
I agree with Jamie. This is a point that I make too, that add together agriculture, construction, and manufacturing, and you've got about 5% of the future labor force. So 95% of us are going to be doing something else, including education and healthcare and so on. So what I've heard is you're an aging society, like all of us. Every society on Earth now is aging. China is the most rapidly aging society on Earth. We're all aging. And number two, you're not ready. And how are you preparing for that? By high unemployment rates of your youth. Anyone see any irony here? So how can you prepare for the future, including the future aged population? Two ways: education and jobs, okay? And get busy now. There actually are infrastructure investments you can make now that will still be used 50 years from now. The private sector will not do this kind of stuff. They have no interest in profits 50 years from now. They want profits 2 years from now. Okay? They're not going to make the investments you need for your aged society of the future. It has to be a government responsibility. You have to start now. And you start now by employing your young people now to get ready to do this in the future. As I already said, unemployment when you're young leads to a lifetime of lower earnings, which may in some way reflect productivity. So it's a disaster, and this is the way we are preparing for it, with high unemployment of our youth. Okay, the other, well, let me just make one response to something Jamie said. The kind of employer of last resort or job guarantee program that we advocate is not a government-run and managed program. It should only be funded by the government, preferably by a central government in Europe of the future. Maybe you'll get one. But we definitely don't want these to be national government-run programs, only funded programs. I agree with Jamie that not-for-profits is the best place to go. If you can't create enough jobs there, municipalities are better than states. States are better than national governments. So you want to decentralize this as much as possible. Create the jobs in every community with the community running and managing the employment. Okay, the other one big issue, because there's a comment, countries have to keep current account balances. Think about the motive for creation of the European Union, other than the cultural, political things, okay, and never have wars again. It was to create a very large economy on the scale of the United States. That was the whole purpose of creating it. So you created it. Then what did you do? You wanted to create a huge internal market so you don't have to rely on the rest of the world. You didn't have to rely on exports to the rest of the world. You don't have to compete with Asia, India, China, because you have a domestic market. You don't need current account surpluses against the rest of the world. But what did you do? You depressed demand within Europe through the instability and no growth pact. Okay? So then what happens is that, yes, a couple of countries can run a current account surplus against the impoverished countries in the South. Okay? So the problem here is lack of aggregate demand. Okay? It's not that you want every country to run a current account surplus or even a current account balance. In the United States, we have no idea which states run current account surpluses and which states run current account deficits. I mean, we can make informed guesses about this, but we don't keep track of this because we could care less. The only thing that matters is jobs. The countries that have current account deficits will tend to be losing jobs to Germany. Okay? How do you resolve that problem? Not by running a current account balance in these countries, but by creating jobs in those countries to replace the ones that they lost. Focus on the jobs, forget the current accounts. Focus on job creation, that's the solution.
So I very much agree with this analysis that you give, but looking at what we discuss in politics, it's right the opposite. Someone said that perhaps it's because the European Union consists of so many small countries that we are all obsessed about current account surpluses because we are used to thinking about exporting. But now we have come to a situation where these ideas have become almost mercantilistic. It's the idea that we should always run a current account surplus. In Sweden, this idea is now very strong. In fact, we have a current account surplus since many years back. We have an export surplus, which is quite big. Nevertheless, the government's target is to double Swedish exports, and Social Democrats' most important job creation proposals are all about increasing exports. The other day, an economist actually said exactly what you said, that perhaps it's the case that now our exchange rate is changing, so it's getting, we have got a stronger currency, so it's getting a little bit more difficult for our companies to export, and people are very upset about this. We haven't understood that you couldn't run a current account surplus always, and it's the idea that domestic demand is something that is not as good as demand from other countries. So we don't do what you propose us to do, neither in Europe nor within our countries. Now, I also think that this has been very important for the rise of neoliberal thinking. In Sweden, we got in the 1980s actually a period where we didn't have a current account surplus. We actually did very badly. This was, in fact, a period when the Swedish population aged very rapidly. Sweden was the first country in the world that got a really age shock in the 1980s. And the Swedish economy reacted exactly as it should. We turned to more of domestic demand. We got lots of people into work with old age care. We had wonderful ways of really working with old age people, good welfare. But in the economic debate, this was a disastrous decade because we didn't have a current account surplus during this decade. So although we managed well, it has been one of the explanations for why we could never go back to Keynesian-type policies with domestic demand. We should always have to work on foreign demand instead. So I think this is very, very important. And as a summarizing point, it's actually the fact that Europe at present has the most positive age structure that you can imagine. It's just as good as China's, because we have so many young people in Southern Europe, so we should be actually doing very, very well. We are not aging yet. It's something to come. So what we are doing now is that we have the best position that we will have forever. Never again will we have such a good situation in Europe when it comes to the size of the supply of labor in comparison to the dependent parts of the population. But we let these people go without jobs. I think this is terrible. And in Sweden we think that the best way to prepare for the aging society is to run a surplus on the budget and to put this surplus in financial papers abroad. And our economists actually say to us now, why do you do that? Swedish investment levels have shrunk terribly down to under 20% of GDP. Our investments in housing, in infrastructure, etc., is on historically low levels. And economists say, why don't you invest at home instead in infrastructure that has a social reward? Why do you put them in financial papers on the international markets? And we say we have to do that because we have to save until we get an aging society. We have to save those papers and this money in a heap instead of investing in young people and in the welfare and education. So this is the situation, so that's far away from what you propose.
Olli and Jukka, brief comments and then we have to...
Yeah, I'll try to be brief. I don't want to spoil the party, but I have some skeptical questions in my mind regarding that the problem was aggregate demand all along, that we don't have enough demand in Europe. Because if you look at the basic data, from 95 to 2005, or from 95 to the financial crisis, there was, let's say, the orthodox way of seeing that was excessive liquidity, excessive overdebtedness, and so on. So there should have been demand in the system. There should have been banks giving out loans to firms, to entrepreneurs, so on, creating jobs, because there's so much liquidity. If in Spain, from 95 on, you could get loan for virtually every project. At least in the housing market, you could get a loan for every kind of house, regardless of what your future earnings would look like. You would have bad loans. So there should have been demand in the system. So I have a little problem with this interpretation that Europe's problem was a lack of demand for all this very long period. So you have to take account, you have to have an explanation for this. My idea for this is that maybe there was some kind of a structural malfunctioning in the system, that all this credit, all this money, liquidity, did not channel into productive things in the society. It was mainly useless. Banks loaning to banks and so on. But so there where we have to hope for some kind of radical structural change in the future, that banking sector would serve more the purpose of the society, useful purposes. And and finally, about where are future jobs coming from? Well, I have to say I'm a young guy, relatively speaking, just 33. So my fellow compatriots, young people, I have to calm you that the Finnish job market is still dynamic. We're creating more than 100,000 jobs every year, maybe around 150,000 new jobs every year, even despite this recession period that we are experiencing. So there's jobs coming, and as James said, the care for the elderly, the hospitals, they will be recruiting more people, and so on, and so on. So final comment on the export-driven growth paradigm. Yes, it's a little bit, in the long run, it's problematic just to be so fundamentalistic about export-driven growth. But I think it's a question of path dependency in a way. We have the current industrial structure in Finland, and it's not going away anywhere. So if we are embarking on policies that would destroy this industrial structure of Finland, this would entail huge social costs as well, because all the industrial workers would lose their jobs, and so we are somewhat path dependent. We have to take care of our industry to manage the social costs.
Tell that to your members, we're path dependent. So I don't know what they would reply. Jukka.
Thank you. 2 short comments only. Where do the jobs come from? I think at the end of the day, the right and the simple answer is that the jobs come from the people. I think it's a statistical fact that size of population and number of jobs in the long run go together, so that there is no other answer. But to modify somewhat of my response, I think in Finland now, the best guarantee for any individual to have a job, to guarantee a job, is to have a high level of education. Because Finland still is a country where differences in structural unemployment across educational levels are one of the highest in Europe. So that there is a likely risk I think about 3/4 risk for low-educated people to find a job compared with youngsters with higher education. So that's still the state of the arts in Finland. And my second comment is on the export-driven growth. I think we should avoid a kind of new mercantilism to think that the exports is an end in itself. Actually, exports is a means to have higher imports in a sustainable way and to increase your standard of living by that way. But having said this, I also have to remind, we have to keep in mind that currently in Finland we have some deep structural problems in our export sector. There is a problem of competitiveness, both in terms of the relative cost level. Then we have the problems with Nokia and ICT. We have a crisis industry in forestry, which is very important to us. So that there is an internal transition in the export sector we have to take care of. And at the same time, there is a kind of global tendency in rich economy to move away from manufacturing to services. In the case of Finland, very often services closely related to manufacturing. This is also the process we have to manage, and I think that's also by ways of educational system we can manage this transition, unavoidable transition, also in the best way. Thank you.
Okay, so I think the message in a way is that for all of you with doctorates and double masters who are unemployed, let's hope that the education pays off, because the Finnish firms aren't investing, as we can see from statistics. And even though we are the third most competitive country in the world, and we have a perfect knowledge infrastructure, everything, but no one is investing, I still like to ask, should we have more demand? But because I'm an arrogant person, I won't give you any more comments. But I would like to all of you just to give applause to our panel. Mikko will still say a few words to end the events.
Before you all escape, I'm not going to make any conclusion, but two concluding remarks. First of all, this afternoon has been, to my mind, it's been fruitful, fascinating, and fun. When we started to arrange this, there was this question about that United States, Europe, they're so different. Do they really communicate with each other? So different labor markets, institutions, and so on. But I think our guests from America has really proved it, that this kind of a dialogue between European systems and United States is actually very, very fruitful and gives us new fresh ideas. So we shouldn't be just talking with those who share the same views. We should learn from other cases. My second concluding comment is then a bit different, because when I, in the 90s, studied and taught at the University of the European Integration, there was, of course, this theory that, well, it started in the late 40s when the United States tried to make divided Europe, an image of itself, a little brother, to get the advantage of scale and so on. And they were so tired of this mosaic that was causing all the trouble. Why can't you be like United States, which was of course prospering at the time? Europe, what a waste to be so divided. Well, after 60 years now, more than 60 years, I think in this debate we still face the same kind of questions. Why is Europe still such a mosaic place? And I think in many of these in this panel debate, for example, when you look at it from the United States and you look at it from a national small country like Finland, there is still the same tension that actually existed already after the Second World War. But like I said, all these debates and exchange of views are the stuff that take us forward. What the way will be, that remains to be seen. I once more thank our speakers, our panelists, and especially all you big audience who has remained here for the whole afternoon. And then in the end, Finally, and I'd like to thank the staff of Kalevi Sorsa Foundation who has arranged this, especially Antti Alaja, who's been the main responsibility, and together with Lauri Holappa, who's been his important colleague in this, in initiating and then arranging this whole meeting. Also, big hand to you. Kalevi Sorsa Foundation is still publishing two books this year. There will be some publications and some events in bringing those books out. Follow our net site, join our email list, and I hope we meet many times again in the events of our think tank. So, if not this year, I wish you all Merry Christmas, but look after those publications.